We are expecting an elevated level of volatility over the next weeks and couple of months, let's say, as we still await clarity on these key issues, that there are going to be plenty of new headlines and that it is too early to be complacent on those key drivers, the outcome of the election and the path of the virus and the response of science, availability of vaccine and therapeutics. And so over this short-term time period, we actually are staying pretty close to home and trying to take advantage of volatility by capturing attractive insurance premium through equity index put writing, while we look to take advantage of volatility also to buy potentially more attractive assets at better prices as we see markets gyrate.
I'll come back to the question of which in order is the most important: vaccine, stimulus, and or election outcome. But let's move on to what you just hit on, which is the idea of you're looking for places where the valuations are still attractive. I assume that large cap and especially large cap stocks, large cap tech, is not where you're finding value these days.
Yes, and it's reflected in our latest views. We've trimmed our exposure to large cap, gone underweight U.S. large cap stocks to fund, as you mentioned, an overweight towards smaller company stocks, which we think on a 12-month horizon will be beneficiaries of additional stimulus and a reflationary impulse in the economies. And we've also shifted some assets to non-U.S. developed markets towards Europe and Japan, where those are responding better in some ways, moving out of some of the challenges we saw sooner and represent some better valuation opportunities. Now, in terms of volatility, I'll tell you, if we do get a sell-off in names, we would then go back into that segment of the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.